I turned $100 into $652, and I also lost 32% on another investment. No fluff. No hype. This is exactly what worked and what failed over the last 4 years. Let me ask you something real. You've got a little cash saved up, maybe $100. Rent's rising. Groceries are stupid expensive. Your job pays the same, but everything else costs more. So what do you do with that $100? If you're like most Americans, you're overwhelmed. You've seen the TikToks. Crypto millionaires. Stock gurus. Gold hoarders. Real estate bros. And you're left wondering, what's actually smart and what's just hype? That's exactly the question I wanted to answer. So 4 years ago, I put my own money to the test. I split $100 into 5 different investments. Things anyone in the US can access from a phone or laptop. Then I tracked them for 4 full years, through crashes, inflation, recoveries, and everything in between. No simulation. Real money. Real outcomes. I put $20 each into 1 individual stocks, 2 REITs, real estate investment trusts, 3 cryptocurrency, for gold, 5 index funds. These are the most talked about options for beginner investors in America today. But I didn't just look at how much money I made. I evaluated each investment based on 5 critical factors that actually matter in real life. 1. Learning curve. How hard is it to understand and use? Do you need a finance degree or just a few YouTube videos? 2. Passive income potential. Can it pay you while you sleep? Like dividends, rental income, or staking rewards? 3. Tax efficiency. How well does it play with the IRS? Can you use accounts like Roth IRAs to grow your money tax-free? 4. Risk level. How likely are you to lose money, and how much? 5. Real results. After 4 years, what is that $100 actually worth? Let's be honest, 2025 is not an easy year to start investing. Inflation is easing, but prices are still high. Interest rates remain stubborn. AI is taking over everything. And too many Americans feel like they're getting left behind financially. You don't need $10,000 to start investing, but you do need clarity. That's why this series exists. I'm breaking down each investment, one by one. What worked? What didn't? What surprised me? By the end, you'll know. Which investments are beginner-friendly? Which ones are overhyped? And how to make smart choices with whatever money you've got. No finance jargon. No sales pitch. Just the real stuff I wish I had known earlier. And we're starting with the one that sounds the most exciting, but ended up being my biggest regret. Individual stocks. I threw a dart, landed on Samsung, and it tanked. But what if I'd landed on Apple instead? Find out exactly how much that decision cost me, in part 2. I threw a dart at a board of 20 random stocks, and I lost over 30%. But what if that dart had landed on Apple instead? Let me show you how one small choice can change everything in investing, and how you can avoid my mistake. Why individual stocks seem so attractive. Let's be real, picking your own stocks feels exciting. You're not just investing. You're owning a piece of a company you believe in. Apple, Tesla, Nvidia. You're thinking, if they win, I win. And yeah, that can happen. But it's not always that simple. The truth about stock picking. To test this, I picked 20 random well-known companies. Then I threw a dart, blindfolded. It landed on Samsung. So I invested $100 in Samsung stock, and waited. No special research. No insider tips. Just one dart. 4 years later, that investment was worth exactly $67.72. That's a negative return of 32.3%. And yes, I did get about 10 cents in dividends, thanks, Samsung. But here's what's wild. What if I had picked better? Let's say the dart had landed just a few inches to the left. Apple, $100, $170. Microsoft, $100, $188. Nvidia, $100, $980 plus. Yes, really. That's the danger of individual stocks. It can feel like a casino. How hard is it to learn this stuff? Honestly, the learning curve is steep. If you want to win with individual stocks, you can't guess. You need to read income statements, understand balance sheets, track leadership teams, follow news cycles, stay updated constantly. If that sounds overwhelming, it is. You're competing with people who do this full-time, with teams, models, and algorithms. And let's not forget, one tweet from Elon Musk can send a stock flying or crashing. Does it make passive income? Yes, some stocks pay dividends, which is passive income. If you buy shares in a company that pays dividends quarterly, you'll get small cash payouts, even if you don't sell the stock. But not all companies pay dividends. Tech stocks, especially, usually don't. So unless you're specifically targeting dividend-paying companies, don't count on this as a reliable income stream. What about taxes? Here's where individual stocks can be super tax efficient if you use the right account. In the US, that means a Roth IRA, no taxes on gains if you follow the rules. A traditional IRA or 401k, tax-deferred growth. A brokerage accounts, you'll pay capital gains tax when you sell. So yes, if you play it smart, you can legally avoid a huge tax bill just by choosing the right account. But the risk? It's high. Let's not sugarcoat it. You could spend months researching a company, buy its stock, and then they miss earnings. Or a scandal hits. Or their CEO steps down. Or a recession hits. And boom, your investment tanks overnight. When I invested in Samsung, it was during a stable period. But even then, I lost 30%, just from market fluctuations. That's why stock picking is not for the faint-hearted. It takes skill, patience, and, honestly, a bit of luck. So should you invest in stocks? Here's my honest answer. If you're passionate about learning, analyzing companies, and willing to take risks, go for it. But if you just want to grow your money without spending hours on research, there are better options, and we'll get to those in the next parts. But if you do want to try stock investing, here's how I recommend starting smart. Use a demo trading app first, like Trading 212 or Fidelity Simulator. Try paper trading with fake money. Study the companies before touching real cash. And never put more than you can afford to lose. The bottom line. I lost money, and I learned a lot. But you don't have to. That $100 investment taught me this. Picking stocks without a strategy is gambling. Picking with research is still risky, but it's calculated. So what's a smarter way to make passive income from real estate, without owning a house, getting a mortgage, or being a landlord? That's where REITs come in. And in part 3, I'll show you how $100 in a REIT outperformed my stocks, with way less stress. You want to invest in real estate, but you don't have $50,000 for a down payment, or time to deal with tenants, toilets, or termites. What if I told you there's a way to own a slice of real estate with just $100? Let me introduce you to one of the most underrated investment vehicles, REITs. What is a REIT, really? A REIT, or Real Estate Investment Trust, is basically a company that owns a bunch of income-producing properties. Think apartment buildings, shopping centers, hotels, warehouses, even data centers and hospitals. And here's the kicker. When you buy a REIT, you're not buying the whole property. You're buying shares in a company that owns the property, just like buying a stock. It's like crowdfunding real estate. You and thousands of others pool money together, and the REIT collects rent and distributes income back to you. Why REITs are game changers for beginners. When I first tested REITs, I put in $100 through an app. That's it. No agents. No closing costs. No mortgage. 4 years later, that REIT was worth $98.59. Not thrilling. But here's the twist. I also earned $10.52 in dividends, bringing my total return to plus 10.52%. Not bad, especially considering I didn't have to deal with property maintenance, illegal paperwork, or chasing down rent checks. REITs and passive income. Here's why REITs are so attractive. By law, REITs are required to pay out at least 90% of their taxable income to shareholders. That means you, as an investor, get a slice of that rent money regularly, usually quarterly or monthly. If you've ever wanted rental income without being a landlord, this is it. Are REITs safe? Compared to individual stocks? Yes, relatively. Most REITs own dozens or hundreds of properties, across cities, states, and sectors. So even if one property underperforms, the rest can make up for it. That's called diversification. That said, they're not risk-free. For example, during the pandemic, commercial REITs took a hit as office buildings sat empty. But other REITs, like data centers and logistics warehouses, boomed due to e-commerce and remote work. So the key is picking the right type of REIT. What types of REITs exist? Here are a few. Residential REITs invest in apartment complexes, student housing. Retail REITs, malls, strip centers. Industrial REITs, warehouses, logistics hubs. Healthcare REITs, hospitals, senior living. Data center REITs, servers, cloud infrastructure. REIT ETFs, bundles of many REITs, for even more diversification. If you're just starting, a REIT ETF might be the easiest and safest option. Do you get tax benefits? Yes, especially if you invest through a Roth IRA or 401k. That way, your REIT dividends and capital gains grow tax-free in Roth or tax-deferred in traditional. If you use a regular brokerage account, you'll pay taxes on dividends, since REIT income is treated as ordinary income, which can be higher than capital gains. But again, that's why the account type matters. How to start with just $100. You don't need a real estate license. You don't need a huge budget. Here's how to start. 1. Download an investing app like Fidelity, Charles Schwab, or Public. 2. Search for REITs or REIT ETFs, e.g., VNQ, SCHH, or O. 3. Set up auto-invest monthly if you want to grow consistently. 4. Optional. Hold inside a Roth IRA for tax advantages. And yes, you can buy fractional shares, so $10, $50, or $100 still works. The real estate investor's shortcut. Let's be honest, everyone wants to be in real estate. But most people can't afford to get started the traditional way. REITs offer a diversification, a passive income, a lower risk, a lower barrier to entry. And while the return may not explode overnight, it's one of the most stress-free and scalable ways to grow wealth long-term. I invested $100 in Bitcoin, and it turned into $652. Sounds amazing, right? But here's the truth. I don't recommend crypto for most beginners. Let me explain why. So what is crypto, really? You've heard the buzzwords. Bitcoin, Ethereum, blockchain, Web3, NFT, UG. But let's break it down simply. Crypto is digital money, decentralized, global, and powered by blockchain technology. No banks, no middlemen, just people transacting peer-to-peer through a secure, encrypted network. The idea is powerful, but the reality? It's a wild ride. My $100 Bitcoin experiment. Back in 2021, I put $100 into Bitcoin and just let it sit. I didn't trade. I didn't panic sell. I didn't chase meme coins. Fast forward to today, 2025, and that $100 is now worth $652. That's a return of over plus 550%. Sounds incredible, right? But hold on. That same $100 in Ethereum would be worth $380. But $100 in Shiba Inu might be 4 cents if you're lucky. Crypto is high risk, high reward. Here's what I always say. Crypto is part investment, part speculation. Prices swing violently. You can 10x in a month, or lose everything overnight. It's not like stocks or real estate. There's no intrinsic value behind most coins. No earnings. No dividends. You're betting on the future of technology and public hype. Learning curve, moderate, but dangerous. It's easier than it used to be to buy crypto. But understanding it, that's another story. To really get it, you need to understand blockchain, tokenomics, a wallet security, gas fees, a on-chain versus off-chain, a regulations, which change constantly. If you mess up, you could lose your money to a hacked exchange, a fake wallet, a wrong address, or forgetting your private key. Yes, that happens. Passive income from crypto? Kind of. Some crypto projects let you earn money by a staking, locking coins to secure the network, a yield farming, lending coins for interest, a liquidity pools. Sounds cool, but it's complicated. It's not guaranteed. You can still lose everything if the coin crashes or the platform gets hacked. So yes, you can make passive income, but it's high risk and often not worth it for beginners. Tax nightmare. Let me be blunt. Crypto is a tax nightmare. In the US, every time you sell crypto, swap one coin for another, use crypto to buy something, it's a taxable event. If you stake coins, that's income. If you sell at a gain, that's capital gains. There are no Roth IRAs or tax shelters for crypto. It's all taxable, all the time. If you don't track your trades, you're in trouble come April. Is crypto safe? Let me show you the risk. The exchanges can collapse. Remember FTX. Wallets can get hacked. Projects can rug pull. Coins can go to zero overnight. Yes, Bitcoin and Ethereum are more established, but they still crash 30 to 50% regularly. If you're gonna invest in crypto, treat it like Vegas money. Only invest what you're 100% okay with losing. So should you invest in crypto? Here's my honest advice. If you're curious about blockchain tech, if you're okay with losing your money, if you only put in 1 to 5% of your portfolio, go for it. Carefully. But if you're a total beginner looking to grow wealth steadily, start with index funds, REITs, or dividend stocks. Crypto is sexy, but for most people, it's just a distraction. What I personally do, I only invest in a Bitcoin, digital gold, Ethereum, infrastructure layer. I store them on a hardware wallet, not on exchanges. I don't trade. I don't time the market. I just buy and hold, and expect nothing. That's how I turned $100 into $652, but I could have just as easily lost it all. So we've done stocks, real estate, and now crypto. But what about the old school classic? One of the safest, most trusted stores of value in human history. Gold. In Part 5, I'll show you how gold protected my money, and why it might be your best bet when the economy gets shaky. What if I told you there's an investment that has survived for over 5,000 years, never lost its value, and always rises when markets crash? Gold. In this part, let me show you why gold is still one of the safest places to store your wealth, especially during times of economic uncertainty. Why gold is different. Gold is scarce, tangible, and universally trusted. It has been used for centuries to protect wealth during economic crashes, wars, a currency devaluation, a global crisis. When everything else falls, gold rises. Gold versus stocks and bonds, a long-term story. Gold is not without its ups and downs, but it doesn't suffer the dramatic losses that stocks or crypto can. In 2008, gold skyrocketed while stocks tanked. In 2020, during the pandemic, gold hit new highs, while the stock market fluctuated wildly. Gold has been a steady store of value, no matter the market chaos. How to invest in gold? You can invest in gold in several ways. 1. Physical gold, bars, coins. Pros, tangible, real asset. Cons, hard to store, could be stolen, not easy to sell quickly. 2. Gold ETFs. Pros, liquid, easy to trade, no storage needed. Cons, no physical ownership, subject to fees. 3. Gold stocks. Pros, potential for dividends, can outperform gold. Cons, tied to company performance, not just gold price. 4. Gold futures. Pros, high profit potential. Cons, risk of losing everything if timing is wrong. Is gold a good investment for the long term? Yes, gold is a reliable, long-term investment. It's the perfect safe haven to protect against inflation and market crashes. Most financial experts recommend holding 5 to 10% of your portfolio in gold for stability. Best time to buy gold. The best time to buy gold is when inflation is rising. Gold tends to stay strong while paper money loses value. A recession's hit. Investors flock to gold for stability. With inflation on the rise and markets uncertain in 2025, now could be the perfect time to consider gold. Gold and taxes. Gold's tax treatment is straightforward. Physical gold, taxed as a collectible, usually 28% in the U.S. A gold ETFs/stocks, taxed like regular stocks, capital gains tax. It's much simpler than the complexities of crypto taxes. My personal gold strategy. Personally, I own physical gold coins for security. I hold a small portion in gold ETFs to hedge against market downturns. I don't trade it. I buy, hold, and watch it grow. For me, it's about stability, security, and peace of mind. Do you want to grow your money in the stock market without spending hours researching individual stocks? An index fund might just be the perfect solution for you. In this video, I'll explain what an index fund is, why it's easy to invest in, and why it's one of the safest investment options available. What is an index fund? An index fund is a type of investment fund that tracks the performance of a specific market index. For example, the S&P 500, which tracks the 500 largest companies in the U.S. Instead of picking individual stocks, when you invest in an index fund, you automatically invest in all the companies in the index. This means you're investing in top-performing companies like Apple, Microsoft, Amazon, Tesla, and many more. Why is it easy to invest in index funds? 1. Simplicity. You don't need to pick individual stocks. Simply invest in the entire market. It's a set-it-and-forget-it approach. No need to constantly research companies. 2. Low cost. Index funds have very low fees because they don't require active management. This means more of your money works for you rather than paying expensive fund managers. 3. Diversification. When you invest in an index fund, you're automatically diversified. For example, an S&P 500 index fund gives you exposure to 500 companies. If one company underperforms, others help balance the risk. Why are index funds low risk? 1. Broad market exposure. Instead of putting all your money into one stock, an index fund spreads your money across many companies in different industries, reducing risk. 2. Long-term growth. While the market may fluctuate short-term, historically, it goes up over time. Index funds let you ride that long-term growth. 3. No guessing. You don't have to guess which stock will perform best. With an index fund, you invest in the overall market, averaging out the ups and downs. The result? 79.5% increase. Over the past 10 years, the S&P 500 index has grown by 79.5%. If you invested $1,000 in an index fund tracking the S&P 500, it would now be worth $1,795. That's consistent growth, without needing to take on high-risk stock picking. Final advice: start early, invest regularly, and harness the power of compound interest. To build wealth with index funds. 1. Start early. The earlier you start, the more time your money has to grow. Compound interest works best when you give it time. 2. Invest regularly. Even small, consistent investments add up. Start with $100 a month and watch it grow. 3. Let compound interest work. The longer your money stays invested, the more powerful compound interest becomes. It's like getting paid interest on your interest. SEO keywords. Index fund beginner. S&P 500 investing. Compound interest. Closing statement. Index funds are one of the easiest, most reliable ways to invest in the stock market. They're simple, low risk, and provide a way to grow your wealth consistently over time. Start early, invest regularly, and let compound interest work for you. If you found value in this video, make sure to like, comment, and subscribe. Let me know in the comments which investment strategy you're most excited to try, And don't forget to share this video with friends or family who might benefit from it. Remember, the best time to start investing was yesterday. The second best time is now.